morning, everybody. It's Thursday, May 16th, and this is the AgYield War Room. Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to you during the show. Overnight markets had July corn up a penny at 463.5. July soybeans were up 3/4 at 1214.25, and July Chicago wheat was up 10.5 at 676.25. This morning's export sales report was okay for corn, 742,200. Low end of the estimates were looking for 700. We had 128,200 for 24. Soybeans were pretty disappointing, 265,700 for 23 and about 25,000 for 24. Low end of the estimates were looking for 300 there. Wheat sales, 78,500 for 23 and 304,300 for 24. So pretty much in line with estimates on the wheat side. And meal was solid, 300,400 for 23 and another 31,100 for 24. Good morning, guys. Hope everybody's doing well. Yesterday, I think the biggest news story or thing that we saw was just the really disappointing NOPA crush number. It was a big whiff on the estimates. Surprisingly, soybeans, small reaction on the close, but nothing really intraday that responded to that report. So, Dustin, maybe a few thoughts to kick us off here this morning. We'll throw it around the room and take it from there.
Yeah, Dan, thank you. I think the market is just having a tough time. Is just getting to some of these levels that I think people find agreeable to start marketing against again. So, I think a lot of people have been talking about the fact that these 24 futures are near $5. We keep, testing, near this level and then failing. And I just, from my experience, it seems to be spurring more selling activity. I think that's probably happening on a much wider scale across the Corn Belt. And guys that, have some time know that they need some more coverage going into 24. And I think it's hedge pressure. Same with beans. It was odd yesterday. We had a really, really bearish NOPA crush report. And beans, remained unfazed for the first half an hour of that report. Eventually, they turned lower on the day. But, there was no knee-jerk reaction to what seemed to be a very bearish number. Maybe it's just needed some time to work its way into the news cycle. But yeah, it's more exciting prices to start thinking about marketing again, and I think you're running into hedge pressure.
Yeah, Ben, thoughts this morning from the East? What's your
I just kind of jumping on what Dustin said there too. Sometimes you get to key areas in corn and wheat in particular yesterday, and then you see a failure of something. We've talked about kind of the systematic trade. As well as really good values, the best values that we had seen in quite a while. A 10-week, kind of the beginning of a 10-week move up in grains coming out of the March to May roll, and it probably was a chance for people to say, "Hey, we're here at the 200-day." We did some selling at the same time. We saw wheat make a new high and fail pretty significantly. So. A combination of hedging and maybe some people trying to get in early on a short corn position. So, the one thing about markets like this is if it's good, it'll go the other way, and it'll punish the people who use that as a barometer to sell. So I think you just continue to monitor pricing action. We've had a nice run up in corn. Setbacks should be expected. And I think we still have a long way to go to prove a yield number. So seasonally, you're always concerned about that. Was this a peak seasonal type of activity? And it just requires some humility where markets can do. We've made some nice moves to improve a plan B and see what they bring us here over the next few weeks.
Yeah, I was going to add to that. I think in these big rallies, corn is hedged by the grower. Beans are kind of that sell off the combine crop from what I've seen. You guys can correct me if you think differently, but it seems like the last at least 5, 6, 7 years, Soybeans, they kind of sell off the combine. They store corn. They might forward market corn. And soybeans, is kind of that thing that they like to, play with until the fall. So I just don't think you see that hedge pressure from the U.S. farmer in soybeans on these rallies. Corn, that's kind of the one that in their mind makes the revenue number. Soybeans is, what they do for rotation purposes, and it's kind of the play one that can move $2 or $3 a bushel. So
Yeah, I would agree with that. I think that, there's a lot more confidence on their ability to grow corn and know what that corn yield is into the season versus what they think their bean yield is, in early August, right? It's still anyone's guess a lot of times. The other thing too is we just came off of a huge transfer of ownership of corn, right? Like corn was the product that most growers stored last year. Beans, we had a couple of things. We had a decent price held for beans through a lot of that time frame because we just were short on beans from acres. We had way too few bean acres, way too many corn acres last year. Decent crops of both, and then high interest rates. So there was definitely an incentive for the grower to sell their beans first and store the corn, just the lower cost of that bin storage space, and it was easier to sell double-digit bean prices when the ratio was high.
Yeah, no, I think that makes sense, and there was less storage money to make.
Right.
So it made sense to do, and I think now it's just interesting that try and catch up on corn sales when corn may be the most friendly and soybeans might be the most bearish. I mean, after this crush number, I think you run what the USDA said for, we're going to gain 125 million bushels of crush for next year and 125 million exports. And now both of those look, way overdone for even old crop. I think you have to really question that 450 carry out. That seems like a very, very optimistic demand number. You could argue that the yield we still have to prove, like we talked about yesterday, but that crush, I mean, you forward that what that crush number means, if we're going to bring in all this used cooking oil for soybean oil biodiesel demand, I mean, really the only reason that crush has been running at 200 million bushels a month is because of all these new plants that were built for biodiesel. So if you're going to import used cooking oil, it's not for meal. We're not crushing 200 million bushels a month for meal. And I think that was what was evident to me in the NOPA number, is that if we're going to import, used cooking oil to meet the biodiesel demand, crush is going to fall significantly from here.
Yeah, and I mean it already has, right? Like, we're coming off of well north of $1 or even $2 crush numbers for a number of months in the last couple of years, and now we're sub $1 again. So seems like the products are saying that.
Yeah, but this is the first time we've seen the crush say that. Like
Right.
we've seen a significant slowdown in crush. I think it's just super bearish beans, versus the products, because if you actually start slowing down the crush, I mean, you're going to hurt. It's actually a super interesting thing where you've had all this, hundreds of billions of dollars pumped into this biodiesel industry, new crush facilities. We've talked about it for years. And all of a sudden we bring in this used cooking oil to disrupt that whole thing. And there's no lobbying going on. Even NOPA came out and said that they're not actively pursuing a lobby against, preventing this. So it's very odd.
As a NOPA member, I mean, that would be infuriating to hear that from your leadership. I couldn't imagine
it's like,
that.
You're not what would you say to do here?
Right.
You're bringing in a huge, you're spending billions of dollars on these plants, and then you bring in cheap Chinese cooking oil.
I know.
Yeah.
Still staying on this topic. The bean corn ratio is like no 24 beans divided by these 24 corn. The ratio is still hanging near the 2.5 to 1, and that's a pretty favorable number for beans. We've incentivized bean acres this whole time. I would say what's changed here coming into the new year is I don't think the market was really expecting that big shift to a lower corn acreage number, the 90 million that we had. So I would say, yeah, if there's ever any surprise, based on the transfer of ownership happening kind of too early in the season last year for beans, we're not getting that natural hedge pressure in beans right now of old crop, and we're not getting, naturally we don't get the hedge pressure on new crop as fast in our experience, at least for beans, as we do for corn. That could justify why the ratio still seems so far out of whack. But and let me get to Doug's question here in 1 second too, because I missed that. But at the end of the year, the change of the of that ratio could be determined on the velocity we change the stocks to use carryout of beans coming from a tight situation to an abundant situation. And I agree. You just look at the numbers, it is going to be kind of a hard path to get carry out where the USDA has put it. We're going to have to do that through demand incentive. So got a couple of up here. Sorry, I missed the first one from Doug.
Yeah, Doug's, I think, Justin, this kind of goes to your earlier point too, so we'll throw it around here, but I guess break down what you feel like, from, kind of a near term, longer term outlook. Is it bearish? So if we're bearish beans and oil, would that tend to be friendly meal, or how does that total crush relationship look in your opinion?
Yeah, I mean, meal's had a significant rally to soybean oil, so it's already made that move. I think maybe on the surface, I would say it's bearish beans, flat price, and maybe meal spreads, firm up, because you would say, if you're going to slow down the crush because we were never crushing when we went from 165, 170 million bushels a month to 200. That was to satisfy biodiesel demand. We were never crushing that much for meal. Now, in the short run, we were able to get rid of it because Argentina ran into problems, so we were able to export the meal. Like, we had good exports. We're still kind of working through that phase, but that was a temporary spike because South America's, Argentina is the biggest exporter of meal and oil, right? So we kind of ran into the perfect storm last year where you were coming off the Argentine drought. We were exporting meal at a record pace, and we were crushing for oil for biodiesel, right? So we had these huge crush numbers. If we're going to continue to import used cooking oil to help satisfy that oil demand, then we don't need to crush 200 million bushels a month. So I think that's what we're trying to figure out here with NOPA. You lowered that, 35 million bushels? So if that's what it's needed to satisfy meal demand, once Argentina is fully online, then I think it lowers that huge crush number for soybeans going forward. So yeah, it's bearish because we've been kind of acting the market, I think, as like, well, we'll just export less and just crush more because this biodiesel industry. That's what's kind of being, put into question here. And the question about meal, sorry, just real quick, Dustin, like the question about meal is, it could be bullish, or it could be, we'll still crush, for meal if we get to that point, but the whole market's just kind of realigning itself with this used cooking oil is really throwing a wrench in the whole, spokes of this thing.
Yeah, if you could pull up the shared screen there, I think this could add to the discussion too, Justin. Just the oil share going back, like we're still, this is more like a long-term average oil share, 37%. We've gotten so accustomed to crushing for meal in the prior decade going into this period, where we're running more like a 30% oil share. And then we hit 50% for the first time in decades, right? What was the, really there's a few
all-time highs, yeah.
Yeah. So it is interesting because the unintended consequences of some of these things are still yet to be figured out. To your point, I do think it's bearish beans because we're pulling in a bunch of used cooking oil because of a tax incentive, and it makes more sense to actually buy that from a tax incentive. Then we need less of probably oil, right, from the crush side. but it could be that we have to slow down crush first, and then meal needs to spike in relation to it to keep, what we do need for meal on the crushing side. It really just depends on how cheap are we importing these used cooking oils, my opinion. And what's the tax incentive to do it? And is there anything to put a stop to it? Because
it's meal exports too, right? So like right now we have this like extra demand for meal. So the question is like, when does that shut off, or does it shut off? Because the meal exports have been kind of balancing that whole equation. If that were to shut off, then it's really bearish the whole complex. And then you could also argue that used cooking oil, for example, like, okay, we're using the heck out of it. The implied usage of soybean oil is still record high, even with all those imports. So you could say like once we work through that, it's super bullish global veg oils at some point, right? Because we're building this giant demand base at super low prices.
Right.
But in the short run, it overwhelmed the market. Like to your point, unintended consequences. But we're still using it, and we're using soybean oil at a record pace. So long term, it could be super bullish veg oils. In the short run, it's bearish the whole bean complex probably.
I did like Nick's comment just to address that. So China is importing South American production, crushing it into oil, and then selling it back to the U.S. as used cooking oil.
Yeah, and actually
What a world.
Even worse is that they're importing Malaysian palm oil, which adds tons of carbon to the environment, packaging it as used cooking oil, and then so it's actually even worse.
Subsidized by U.S. taxpayers.
Yeah. So thank you, America.
Oh, what a world.
Yeah.
Hey, Rye, real quick, give me a shot at the livestock here.
Yeah, pretty quiet day yesterday. Just some consolidation, kind of narrow trade in both places. I think everybody's waiting to see what happens with the cash market here. Weekly exports really were nothing to write home about. Maybe a slight uptick from the previous week. 15,000 metric tons in beef. Pork exports were marketing year low. So still waiting for a little bit better news on the hog side of things. Market's a sub 100-day moving average in June. And, I think just overall, there's just not a lot of great news hog wise, just still liquidation from funds at this point. So just really waiting to see if we're going to see any real support there. Otherwise, cash, we saw a little in the live cattle side, saw a little 184. Pretty slow to start though. It's not enough to really say that's where it's going to finish out. North is probably still going to be a little bit higher here than that. And I would I would think there's going to be a little bit more focus on the weight data this week that comes out later today, just to see if the recent weather is starting to affect steer weight. So if it drops a little bit more than expected, or if it does drop even at all, I think at this point, market may look at that as kind of friendly. So I think we're going to trade in front of that for the time being. And we're up a little bit right now. So
very good. Appreciate the update. Just came into the open. We've got July corn up 1.5 pennies now, 464.25. July soybeans up 5 at 12.18.5, and July Chicago wheat is up 11 at 677. Tomorrow is Friday. We will have Fun Fact Friday, so everybody tune in. That'll be always exciting to hear from Brian. Appreciate Nick and Doug's thoughts this morning, guys. It was a good conversation. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live. 8:15 Central Time. Hope everybody has a great day. We look forward to talking to you tomorrow.